it's time to sell your short-term rental. That might be because it's not performing like it used to. You might be upgrading to a larger property, or maybe just moving that money into a different asset. But before you list it and cash that check and ride off into the sunset, how much money are you actually going to walk away with after taxes? Because a $100,000 check at closing doesn't mean $100,000 in your bank account. And it definitely doesn't mean you only pay taxes on $100,000. And in this video, I'm going to break down exactly what happens when you sell, how to time your sale for maximum cash flow, and how to calculate your real estate tax liability, and how to reinvest those proceeds without losing momentum or giving half of it to the IRS. Let's get into it. By now, you've determined that you need to sell your property because you did the return on equity analysis. And if you didn't do that, go check out my last podcast video on exactly how to do this to know whether or not you should sell your property. Is it the right time to sell though? Okay, you have to understand what your peak season is in your market, and every short-term rental market is going to be a little bit different. Are you in the Midwest on a lake where your lower season is, say, October through March? You don't want to sell your property during peak season. You don't want to sell your property during May, June, July, because that's when you're getting all your bookings and you're going to collect the most cash. So understanding what time of the year is the right time to sell your property is very crucial. And this is also important when you go to buy a property as well. You wouldn't want to buy a property in the middle of peak season because it would take you 2 months to get it ready. And then by then you're going to miss the entire peak season. You want to buy it out of peak season so that way you have enough time to get it ready for peak season. So understanding when to buy the property is very important. When to sell the property is also very important. Let's talk about the equity side. What will you actually receive when you sell the property? Now, what I talk about is there's equity before taxes and there's equity after taxes. So generally speaking, if you're going to sell a property, let's say you had a property and it's worth $500,000 and you had an outstanding loan of $200,000, you might think that you would sell the property and get $300,000 of equity. However, there are closing costs, okay? And some of these can be negotiable, some of them not. Now, typically most sellers are going to end up paying 6 to 6.5%, probably 6% in closing costs, but that's on the fair market value. So 6% of the 500, I'm paying $30,000 in closing costs, right? So that $300,000 of equity that I got, I have to subtract that. I have to subtract my closing costs from that equity amount. So I'm really only walking away with $270,000, okay? This is also very important if you've refinanced your property, okay? Because the difference between the fair market value and the loan minus closing costs is what you're actually going to receive when you sell the property. Now, this is equity before taxes. Equity before taxes, very important. So this property I purchased for $100,000. It's worth $500,000 now. And let's say along the way, I refinanced the property and I took out a $400,000 loan. How much money am I going to walk away with at closing? Well, it's going to be what the property is worth minus the loan, minus the closing costs. And on this deal, I'm going to walk away with about $70,000. Now, a lot of investors believe that the amount of money that they walk away with at closing is the amount of money that they have to pay taxes on. And this is very far from the truth. You see, the amount of money that you pay taxes on is irrelevant with your loan balance, okay? So the amount of money that you actually walk away with is not the amount of money that you pay taxes on. Because I bought this property for $100,000 and now it's worth $500,000. I pay taxes on the difference between $500,000 and $100,000. So I would pay taxes on $400,000. But what happened? Well, I only walked away with $70,000. So you might think that you only have to pay taxes on $70,000. You don't. You pay taxes on the difference between what you sold the property for and what you originally bought it for, okay? And so in this example that I'm showing you, let's assume that the taxpayer has average 25% tax rate between federal and state. They're paying $90,000 in taxes on that property, but they only walked away from the closing table with $70,000. This is what you have to be careful about. When we're calculating our tax liability and our equity, we have to understand how the loan proceeds play into account. Because I've seen this over and over again where the taxpayer actually walks away at the closing table with less money than what their tax bill is. And I don't want that to be you, and that's why it's very important to understand this. Let's talk about the different types of taxes. A lot of people just think it's capital gains tax, right? You have capital gains tax, and those are going to be at 0, 15, or 20, depending on how much money you make, okay? I believe for married couples, you can make about a $550,000 before you're in the 20% capital gains rate. The other tax you might have are going to be state taxes if you sell the property in a state that has income tax. And this can vary. Sometimes it could be as low as 2.5% if you're in Arizona, all the way up to 13% if you're in New Jersey. You're also going to have what's called depreciation recapture. This is something that most investors miss out on because over time, while you own the property, you're getting tax write-offs and you're getting benefits while owning the property that you can use to offset your tax bill each year. And when you go to sell the property, you have to recapture that. Now, depreciation recapture is going to normally be at your ordinary tax rate. And what I mean by that is whatever you're making that year from your W-2 or from your business or from the sale of stuff, that's what your ordinary tax rate is. Now, how do we game plan around this? Well, ideally, you sell a property when you're in a low income tax year. So maybe one spouse quit their job, maybe you're traveling or you're not working half a year. That's a great time to actually sell a property because your tax bracket's so low. You're going to pay less than capital gains tax, you're going to pay less than state taxes, and you're going to pay less than depreciation recapture taxes. Last one, and it's also the hidden one, is what's called net investment income tax. Okay, this is for if you're single making over $200,000 a year, or if you're married making over $250,000 a year, you have to pay a surcharge on investment income over those amounts. And this is 3.8% of the gain. So you add all these things up, you have capital gains tax, state tax, depreciation recapture, net investment income tax. You add all these up, and it's not out of the picture for the average investor to pay 30 to 35% in taxes on the sale of a property. And I'm here to show you guys how you can actually avoid that by coming up with tax strategies that you can implement that support your decisions and support your investing goals. By the way, if you're looking to make this exit without getting slammed in taxes, that's exactly what my team and I do. We work one-on-one with real estate investors, not only helping them save $10,000 to $50,000 a year on taxes, but also helping them understand numbers like we're talking about in this video. And we'll build you an exit strategy for this property and a strategy for your next one. And we'll hold your hand for the next 12 months as you scale your portfolio. If that's interesting to you, click the first link in the description and there's more info on the next page. First, the best thing you want to do is figure out where you want to redeploy the capital. So some various ways that you can redeploy capital and still get tax savings would be to invest in another property. This is going to be the biggest bang for your buck. It's going to help you save the most amount of money in taxes. And most importantly, it's going to allow you to increase your net worth over time. A lot of people want to sell a property and take the money and go buy a car, a nice car or a vehicle. And the problem with that is, yes, you get a tax deduction for it. However, in 5 years, your net worth will be less. I guarantee it. I promise you that if you get in the habit of buying vehicles, your net worth is going to go down over time. Wouldn't recommend it. Invest in a property is an option to save money on taxes. Retirement accounts are also an option, okay? If you are a W-2 employee, you can put $23,500 into a retirement account to help defer your tax liability. So maybe you have a rental property or a couple of rental properties and you don't have a lot of money in retirement. Well, when you sell your property, that's a great time to put that money in a retirement account because you can help offset the taxes that you're going to have to pay on that sale. If you want to put the retirement account on steroids, then you do what's called a solo 401k. Okay, this is if you're self-employed. If you're self-employed, you don't follow the same rules as regular employed people. You actually can contribute up to $68,000 a year in a solo 401k if you have enough income. So it's a great tax deferral strategy by taking money from your rental property and investing it into either other investment properties or retirement accounts. If buying another property, let's talk about it. If I want to buy another rental property, what are my options to buy a rental property? Okay, we can either do what's called a 1031 exchange, or lazy 1031 exchange. Now, let me walk you through the differences. So a regular 1031 exchange is where when you sell your first property, you do not get that money. That money does not go to you. It actually goes to your qualified intermediary. This is somebody that's helping you oversee the transaction. So the check from the closing company or the title company actually goes to the qualified intermediary. You never see that money. And with a 1031 exchange, you have to understand the very important rules. You have 45 days from when you sell a property to identify up to 3 replacement properties, in writing, by the way, and you have 180 days from sale to close on one of those 3 properties. Most people understand this. The part that a lot of people don't understand is the math guidelines on this, because the fair market value from the sale has to be greater or equal to the purchase price. Okay, so if you sold a property for $500,000, you also have to buy another property for at least $500,000. Your equity also has to remain the same or greater. So if I sold a property for $500K and my equity in it, let's say I had $300,000 of equity, I also have to roll this $300,000 of equity into the next deal. Maybe you want to do that, maybe you don't. What if a home was completely paid off? If you had a $500,000 property and you had no loan on it and you sold it with a 1031 exchange, you'd have to put that entire $500K into the next property in order for it to be a complete 1031 deferral. What most investors don't take into account is the stress that a 1031 can bring. Because of the timing deadlines, the math guidelines, it's really hard for a first-time person to do and complete a 1031 exchange. In fact, 27% of 1031 exchanges fail. Either the investor doesn't identify the property in time, or they don't close on the property in time, or they don't meet the sale and purchase guidelines for the fair market value and the equity. Now, let me talk about another strategy. If you still want to buy rental properties, but you don't want to go through the hassle of a 1031, you do what's called the lazy 1031. This one's simple. All you have to do is buy another property in the same year that you sell the property. So if I sold a property on March 1st, 2025, I want to make sure that I buy another property and I get it live before the end of the year. Before the end of the year. Very important. Timing is so important when it comes to saving money on taxes. See, if I sold a property in October, I have to get the new property up and running and live before December 31st if I want to save money on taxes. And that's extremely important to make sure that you're timing the sale. So lazy 1031, the way that works is when you sell the property, the money goes to your bank account and you can do whatever you want with it. But if you do not invest a certain amount into another property, then you're not going to be able to defer your tax liability. So this is something that we help investors with. If you're wanting to figure out, hey, I want to do the lazy 1031, but I need to know how much property to buy, we have resources and we can help our clients do that. Now, the last thing that you want to check before you decide if you should do one of these strategies is how many losses do you have carrying forward, okay? If you have losses carrying forward from properties or other properties, those actually go towards offsetting your tax liability. And you may not even need to do a 1031. We had a client one time who was so adamant about doing a 1031 exchange. She thought that it was the only option for her to save money on taxes. And she didn't know that she had $300,000 of losses carrying forward on her tax return. And the gain on the property was only $220,000. So those losses that she had carrying forward were enough to offset her capital gain from the sale. So she didn't need to do a 1031 and jump through all those hoops because she had enough losses carrying forward. And if you're looking to see how much losses you have carrying forward, that's going to show up on Form 8582 of your tax return. So before you decide what strategy you want to implement, double check your tax return to see if you have any carry forward losses. So by now you've learned if now is the right time to sell your property or not. You've also learned how much equity you're going to receive at closing. You've also learned all the various taxes that you may or may not have to pay when you sell a rental property. You also learned what are your options for lowering your tax liability, whether it's buy another property, invest in a retirement account, and you've also learned which strategy you should do. And you've also learned to make sure to check your previous year tax return just in case, so that way you don't have to do a 1031 exchange. If you like this video, you're definitely going to like this one. Check it out and I'll see you over there.